Respected dignitaries, senior colleagues, junior colleagues, very happy good evening to all of you. My presentation is titled as KISS Ideology in Personal Finance. The full form is Keep It Simple Strategy. Before I start my presentation, a word of caution or a sort of disclaimer. This KISS ideology is strictly for the investment horizon of 5 years or more. I'll explore it once again. About myself, Dr. Rajnikant Gajjar. I passed my MD in anesthesia in 1988 from Medical College, Baroda, MS University of Baroda. I am located at Bharuch, Gujarat. The tallest statue in the world, that of Sardar Vallabhbhai Patel, is situated in a Kevadia town of our Bharuch district. I am NISM certified in Investment Advisory Level 1. I am NISM certified in Retirement Planning. I am NISM certified in Mutual Fund Distribution as well. Let me make one thing very clear. I pass all these exams only to quantify and to evaluate my knowledge in personal finance and its understandings. I have no business or professional or commercial interests involved in these certifications. I do write on my blog rk@gajjar.wordpress.com, usually on personal finance. I share my mobile number with you. I share my email ID with you. This is only to let you know that not only today, but henceforth, anytime, if my services can be of any use, any help in personal finance related matters, I am at your service. Of course, definitely free of cost. I will be discussing my topics under 6 headings: outlines, the general principles in personal finance, options, the various options in my ideology, operations, how this ideology is to be operated, outcomes, what do I expect as a result from this ideology. Only for handholding, I'll give you the names of few mutual funds only for handholding. In original views, I'll share my personal views in personal finance. Outlines. This includes the rules that are basic and fundamental. They are not to be violated at any time, and they are always to be followed. Outlines. I repeat again, the funds required or likely to be required in immediate 2 or 3 years must be in short-term debt funds or bank FD, no second thoughts about it. So only if you have the funds which are not required for a period of 5 years or more, only those funds are to be used, to be utilized employing this KISS ideology. Consider this as a voluntary lock-in, like a 5-year bank FD or a 5-year NSE certificates. Options explored in this strategy are in a pair. There will be one volatile fund and one will be a stable fund. Volatile fund is for the wealth creation purposes, and the stable fund is for the wealth preservation purposes and for stability of the portfolio. Rebalancing as per the plan strategy allocation is mandatory irrespective of the moods of investor or Mr. Market. I'll explain this little later also. This strategy is a goal-based strategy. So smart goal must be defined. It can be anything like accumulating 20 lakhs, 50 lakhs, 1 crore, 10 crores over a period of 5 years, 7 years, 10 years. It may be whatever. But a goal has to be a smart one. What do I mean by smart? Smart here, S stands for specific and significant, means it must be a pinpointed goal. Measurable and meaningful for M, it means that it must have a purpose in your personal financial life. A stands for attainable and action-oriented, means to realize that goal, there must be some dedication, efforts, and sincerity from your side as was required. Realistic and relevant, meaning if I at my age of 62 think I want to be Rakesh Zunjurwala, it is unrealistic. So it has to be realistic and relevant. It must be time-bound and trackable. You must fix a timeline when you want to reach a particular goal. And during the journey to that particular goal, the path that you have taken is whether correct or not, must be able to appreciate. So it must be trackable. I repeat this acronym with the full form: S for the specific and significant, M for the measurable and meaningful, A for the attainable and action-oriented, R for the realistic and relevant, T for the time-bound and trackable. What is the ultimate goal in our life? Financial independence. At one or the other stage in our life, we must have assets, financial assets or other assets, which deliver us return, interest or withdrawal, so that this return is enough to fulfill all our livelihood requirements, our basic needs of our life, and to some extent, so many of our advanced needs of our life. We must not be in a compulsion. We must not be compelled to use our mental energy, physical energy, or intellectual energy to earn, to fulfill these basic needs, advanced needs in our life. That is the stage of financial independence. We don't have to work, but we work because we want to work. That is a financial independence. The investable funds are divided equally between the two, volatile and the stable. The options are three options. I have opted for the equity savings funds as a stable fund instead of the debt funds because of the favorable tax treatment on redemptions with EQSS as compared to the debt category due to the latest budget changes on long-term capital gains with respect to the pure debt category. In last budget, the cost inflation indexation benefit applied to the debt funds for a period of 36 months and more is taken away. So they are now not so tax efficient. EQSS are the most stable in the hybrid category and they get the benefits of the equity taxation. Capital gains up to 1 lakh rupees of the tax is capital gains up to 1 lakh is totally tax free, and in addition to it, whatever is the amount is charged only at 10%. EQSS are at par with all equity funds from taxation benefits. It is better if you select both the funds, that is the volatile and the stable funds from the same fund house, so that the switch, that is the rebalancing or that is the buy or sell decisions is carried out efficiently and easily. One more clarity, EQSS and ELSS, they are opposite poles. They are not at all similar. ELSS is for the equity linked saving schemes eligible under ATC. EQSS are not eligible under ATC. EQSS are stable, ELSS are highly volatile. The first option, it is a pair of the aggressive hybrid fund and a stable fund. Aggressive hybrid fund is a volatile one and stable fund is the equity savings fund. Aggressive hybrid fund has 65 to 80% equity exposure, rest is in the debt. They have highest exposure in the equity in hybrid category with inbuilt rebalancing every 30 days. That means whenever the market is up, there is profit booking, or whenever there is market down, there is top up in the investments. This is all done without investors' involvement or without any procedural or taxation burden passed on to the investor. So this is a volatile fund. Equity savings funds, they also have 65% in equity or more than that, but they have two types of equity. Unhedged equity, that is a pure equity subject to the market volatility, and hedge equity or arbitrage opportunities, which is more stable, which is not so vulnerable to the market volatility. Equity savings scheme is at the bottom of volatility measures in the hybrid category, so it is a stable. This is active investment strategy option. Herein the fund manager decides which shares, which stocks or which debt papers to buy. So his experience, his exposure, his skills will determine the outcome of the aggressive hybrid fund as well as equity savings fund. I'll talk about the rebalancing in next half. Second option here, again, as I said, the stable fund remains same, equity savings schemes, EQSS, but the volatile fund is changed. It can be either BSE Sensex or it can be NSE Nifty 50. One can select one of the two or one can divide equally between the two. That is BSE Sensex 25% and NSE Nifty 25%. Here again, both the funds get favorable tax treatment on capital gains because of rebalancing. This is a passive investment strategy option because here in the fund manager will not decide his skill, his experience is not put into exercise because the shares and stocks are selected according to the BSE Sensex or according to the NSE Nifty 50. So it is a passive investment strategy. Third option is the National Pension Scheme. NPS has two tiers. Tier 1 is for the retirement. It is a lock-in till your age of 60. But NPS Tier 2 is for all other life goals. There is no lock-in. You can put your funds at any time. You can withdraw your funds at any time without any restrictions. Here, the will select only two asset classes. That is equity. Equity will become the volatile fund, and corporate bonds, that will become the stable funds. Here also we'll be dividing equally between the two 50-50, and we'll also be carrying out rebalancing as is done in the previous two options. And NPS also permits such 4 rebalancing changes or asset allocation changes in a year without any charge to the investor. Herein, there are two options, active and auto, but we'll go for the active options because active option permits us to decide the allocation to the equity and the corporate bonds. NPS is an investment plan with the lowest expense ratio of 0.0982%. That means if one invests even 10 lakhs of rupees, only 982 rupees, that is even less than 1000 rupees I charge for the expenses. And the rest of entire corpus, entire fund is invested and one gets the benefits out of the investments. Lowest expense ratio has significant advantage when it gets compounded over decades. So that completes the options. Operations. Continue to invest 50% of the investable funds in both the funds, volatile and stable, regularly or as and when the funds are available. What is mandatory is you have to value your total portfolio as per the market NAV at least once in a quarter. Now, define the percentage-based weightage of both the funds in valuation portfolio. We have started with 50-50%. Now, where they have gone. If a fund has risen to the 60% weightage or fallen to the 40% weightage, means there is a significant 10% change, rebalance in a way that the strategic 50% weightage to both the funds is achieved again. The aim here is to do rebalancing as per the percentage in the valuation and not time-bound rebalancing. So it may happen in a particular quarter, one fund goes up to 52%, another fund goes down to 48%. This is not a significant change. You can ignore and continue the investment. One more clarity, here there can be a conservative investor. For him, 5% is significant. So he may do the changes at the 55 and 45. Or there can be an aggressive investor. For him, the significance lies at 20%. So he may do the changes at either 70% or 30%. That is one's choice. But the aim is to nullify the market and investor moods bias on the investment strategy. Here it is not that the market is up or market is down or the advisor has advised or the friend has advised. That will take the call for buy or sell or for rebalancing. Here it is the strategic allocation of your funds that will decide the buy and sell or rebalancing. This is as simple as that, sir. Outcomes. What do I expect? This ideology will lead to a simple, sustainable, and strong strategy to create the wealth. I also identify as a triple S wealth strategy. Why it is simple? Because here you have to only make once in a lifetime selection of schemes, 2 SIL funds. That is as simple as that. You don't have to think again and again. Because it is simple, it is sustainable for decades and decades altogether. You can continue with it. And because it is sustained for decades, compounding helps it to become it so strong that it is able to fulfill majority of your financial goals. Dear colleagues, either in investments or in individual life, it is not the quality or it is not the quantity, but it is the consistency that creates the character or quantum of wealth. This triple S strategy stays with you whether the market is up or down in your path to wealth creation. In fact, it is the up and down that only makes this strategy strong enough. Now, what is the scientific basis or foundation of this KISS ideology in personal finance? There is a textbook in investment, The Intelligent Investor. It is also considered as good as a Bible in investing. The author is Benjamin Graham. It is a well-known authority. He recommends a 50% stocks and 50% bonds allocation for the typical investor, retail investor, who cannot spare the time for deeper investigation into the security selections and tactical asset allocation. So this is the scientific basis, evidence or foundation of my KISS ideology. Now only for hand holding, there are many portals which publish the lists of top mutual funds, best mutual funds, investment-worthy mutual funds like Value Research Online, Morningstar, Economic Times Wealth, ET Money, Money Control, many more. Select a portal whom you trust and select the funds in the categories that are identified in our options, aggressive hybrid and equity savings schemes. I share with you Value Research Online May 23 issue recommendations only as example, not as a recommendation. One more clarity here. These selected funds, if they consistently underperform with the peers in category or with respect to the benchmarks for consecutive number of years, they definitely need to be reevaluated and changed if required. But at the same time, do avoid rapid and frequent changes. Only if a fund has not performed for a quarter, 2 quarters, or a year, do not do the changes. Allow enough incubation period as well. So the names identified now. In aggressive hybrid category, ICICI Prudential Equity and Debt, Kotak Equity Hybrid, Edelweiss Aggressive Hybrid. In equity assets category, ICICI Pru Equity Savings, Kotak Equity Savings, and Edelweiss Equity Savings. You can mark out, I have selected the funds in both the categories, both the options from the same fund houses, so that the buy and sell or rebalancing or switch is a simple and efficient job, easily done. For the index funds, they are to be selected on the basis of the high assets under management, low expense ratio, and low tracking error. This being a simple job, you Google the index funds, find out the fund with the highest assets under management, low expense ratio, and low tracking error, and go for it. As simple as that. Now, views in personal finance. A guide is definitely required, but pleasure lies in doing it on our own. We did residency under professors, registrars, and seniors, but we enjoyed more doing our job independently. Similarly, all mutual funds investments are to be done in DGO mode. D stands for the direct plan, G for the growth option, and O for the only open-ended mutual funds. So in mutual funds, always go for the direct plan, always go for the growth option, always go for the open-ended mutual funds. Now the equal allocation, that is 50% each between the volatile and the stable funds, as strategic allocation has proved to be more beneficial in studies. There can be other strategic allocations also like 60-40, 70-30, 80-20, but this is more beneficial. And to support or substantiate my claim, I also share with you an article which proves that this ideology, 50% allocation, is a better one. Now, let me clarify. I have not invested in any of the schemes identified in this presentation, nor I have evaluated them in details. But I do follow this key ideology in personal finance in my personal life. This is a feel it, set it, and forget it style strategy. Colleagues, simplicity is the ultimate sophistication. It is so simple to be happy, but it is extremely difficult to be simple. Now in Western world, there is a craze or a trend for the minimalism. In minimalism, they use minimal assets, minimal gadgets, minimal utensils. They have minimal dependence on the other things to become happy. I have employed the same minimalism approach in this money management in KISS ideology. I have selected only 2 funds, minimal funds, and I am sure minimalism can make and will make miracles in money management as well. Another thing in personal finance, colleagues, you need a lot of patience, strong and dedicated discipline, and immense faith in pursuing the ideology or the strategy that you have selected to realize your personal financial goals. This is not a 2020 match. This is not a one-day international. This is neither a test match. Personal financial goals realization is a lifelong exercise spread over decades. So you need lots of patience, strong and dedicated discipline, and immense faith to realize it. Another key in personal finance to succeed is to have a goal-based investing and its aligned assets allocation strategy. Whenever you invest, you must have a goal, and this goal will decide when you will exit from the particular investment. So goal-based investing and its aligned assets allocation strategy is the key. One more thing in personal finance is you must differentiate the negotiable and non-negotiable goals in your life, and you must pursue them differently. Non-negotiable goals are, emergency funds, kids' education, and retirement planning. These are non-negotiable goals. It means, suppose if we need 100 rupees for these goals, we do need 100 rupees. We cannot do with 80 rupees, 90 rupees, 95 rupees. We need 100 means we need 100 rupees. So in pursuing these goals, we have to be a little bit conservative, at the base moderate. We should not be aggressive or over adventurous. But for negotiable goals, like say a farmhouse or a foreign vacation or a big and expensive car, these are negotiable goals. If you do not succeed in realizing the funds for these goals, it will not make a big impact in your personal life. So here you can be a little more bold, more adventurous, and more aggressive. So identify the goals that are non-negotiable and negotiable and pursue them differently. This ends my presentation, colleagues. At the end, I again repeat my blog address, rksgajjar.wordpress.com. I have already shared my contact details with you. Today and henceforth, I am ready to help you out in personal financial matters. As I said it again, I have no business or professional motives to earn out of. That ends my presentation, and I am really thankful to all of you. Thank you, everybody.